Hi, we're Group 5, and today we'll share our thoughts on the Canterbury case. The first question was whether or not we think the board should approve or not approve the $4 billion bid for Adams. To highlight some of the pros and cons that my colleagues are going to go into, we think that the bid will help Cadbury catch up to Wiggly in terms of the gum segment. Cadbury is also strong in manufacturing and brand management, which will help them make Adams more successful. There is a strong cultural fit, and there's a geographic fit as Adams will bring in the Latin American market, and there's a similar cost structure between the two companies. In terms of cons, we saw that there's a lack of experience in the management team at Cadbury's. There's stagnation in both of these organizations' businesses in terms of their profits recently, and the U.S. market is currently declining. Adams products also face a decrease in their operating margins, which may be concerning. But overall, we felt that Cadbury is a financially healthy company. Their debt to equity ratio is below 0.5. Their interest rates are decreasing. Their return on equity is increasing. And in 2001, it was 18%. Return on assets is also good at 7.7%. So we believe that they can finance that acquisition. And though the bid is a little high, acquiring Adams is a good strategic move, and my colleagues will discuss why.
Yeah, so the strategic fit assessment of this acquisition is we feel that Adams fits very well into Cadbury's corporate theory. Presently, they focus heavily on confections, chocolates, and things like that, whereas they are very weak in the gum market. And this is where Adams really shines. They have 21% of the global market. So if the acquisition were to be successful, we'd see the combination of them being roughly 25% of the global market, making them a real force in this segment. It's also thought to be a good cultural fit between the two. They operate very similarly within each of the companies, and it also fits into what Cadbury has been doing in regards their growth strategy, which as of late has been via acquisition. They had acquired several companies in the chewing gum sector in Europe and in the Middle East, and so Adams is a natural fit into what they're doing there as well. Of course, there will be some challenges in particular regards to Cadbury's operational structure. One operates a very centralized model, whereas the other is highly decentralized. So the integration could be challenging for them. There's also a lack of leadership experience in regards to Cadbury. This would be the biggest thing that they've had to experience. So it'll be a real test of the leadership. And we also saw some softening of the market, particularly in the confections sector where Cadbury is very strong in. But overall, presently Adams is not a strategic fit for their current owner, and moving them out of Pfizer would certainly open up the ability for Adams to become even more innovative in their products, and we feel Cadbury has the right atmosphere to do that. So overall, we feel it's a great strategic fit.
Yeah, from a strategic standpoint, we believe that Adams will allow for more global diversification, which is something that Cadbury has really struggled with in the past. We believe also that Adams is a better cultural fit with Cadbury and not with Pfizer. Pfizer being a pharmaceutical company, that we think that by merging Cadbury and Adams together, it's gonna fit better, and that they're going to be able to play off of each other better and really grow. It does give Cadbury a chance to become an elite packaged goods company as well, which is something that they really need at this point in the market. There were several skeptics about this bid that we wanted to discuss. There was thought that Adams may not be as strong of a company as was once thought, and we think that they are a strong company. We just think that they've had poor management in the past, mostly because that management has been focused on pharmaceuticals and not on the gum and food processing type. So we think that once management gets in there and turns it around, it will be very successful. There was another analyst that believed that Cadbury would not benefit from any kind of cost synergies, and we didn't believe that is true either. The skeptic himself said that sugar is not a commodity that's purchased that way. but with the packaging and with other raw materials, that there still are amazing cost-saving opportunities there, especially when you buy in large quantities. So we thought that both companies could take advantage of these larger quantities that are being purchased.
So as far as the overall costs that we came to, cost that we decided was $4.1 billion, which we understand is aggressive, but we feel as if it is justified. The average EBITDA for Adams over the past 4 years was about $260 million per year. Similar companies that were acquired recently received a multiplier of about 15.7, which puts the total cost right there at that 4.1 billion. So we do feel it's justified. And as my team talked about the synergies, we believe there's a lot of revenue to be gained. We believe there's about 275 million in revenue synergies to be gained. But also, we talked about cost savings. We feel that there's about half of a billion dollars of cost synergies. One synergy alone, we feel like could be close to $250 million. So we feel as if the cost, although is aggressive, is definitely justified. We also understand our place within the market, where we may have to be aggressive to outbid, a Pepsi or a Wrigley or any other big company that we feel may be involved. So it is aggressive, but we feel excited and justified within our decision.